People underestimate how profoundly the world changed after the 2008 financial crisis. The business cycle structure has become eerily predictable, ticking like a metronome every 4 years. Back in 2008, governments were drowning in debt, especially those over 100% debt to GDP. So there was a debt jubilee, meaning that essentially they just forgave all of the interest payments, allowing governments to use GDP growth to pay down the principal on the debt rather than just stuck in an endless cycle of needing GDP growth to pay off just the interest. So since 2008, all economic growth was effectively redirected to tackling those massive debts. They aggressively restructured these debts, typically over a 3 to 5 year period, and this created a near perfect 4-year liquidity cycle. So every 4th year, a disproportionately large chunk of that government debt comes due. To manage this, central banks incrementally inject liquidity into the system over 3 years, building up to a peak in that crucial 4th year. But here's the catch. That liquidity surge is never fully pulled back. While some liquidity might be withdrawn during bear markets by raising interest rates, the overall trend is clear. The net amount of money in the system just keeps climbing. Globally, this liquidity is expanding at an astonishing rate of around 8% annually. Think of this 8% as the effective debasement rate of fiat currencies, the true rate of inflation. This is how much purchasing power the money in your bank loses each year just from sheer expansion of the money supply. Something fascinating happens when you look at markets through this lens. The mighty S&P 500, the bedrock of many portfolios worldwide, is essentially just about breaking even. And it's not just the S&P. Most traditional markets around the world look remarkably similar once you factor in this debasement rate. They're effectively going nowhere. When you cut through the noise and look at the world through this objective lens, only 2 asset classes consistently outperform: tech stocks and Bitcoin. GDP growth at its core is driven by a simple formula. It's a combination of debt growth, population growth, and productivity growth. But there's one massive long-term factor impacting all markets right now: our aging global population. Birth rates are plummeting worldwide. This directly impacts the workforce. The labor force participation rate is also in decline. Whether in the US or elsewhere, it's ultimately a function of births and deaths, and right now, the numbers aren't looking good. They say demographics are destiny, and that's largely true, unless something fundamentally changes. So what could change it? Well, the arrival of AI agents and humanoid robots potentially within the next 5 years, which will redefine labor entirely. In the meantime, with declining population growth hitting their GDP numbers, governments have resorted to one major lever: artificially increasing government debt to try and offset that slowing growth. This is why government debt is ballooning. As the labor force shrinks, economic growth slows. To paper over this, governments borrow more, which fuels inflation, increases the cost of living, and widens inequality. What does that do? It further discourages labor force participation, which in turn hurts GDP growth and requires even more debt expansion. It's a truly vicious downward spiral, a destructive cycle that many people intuitively feel even if they can't quite articulate it. So what are governments essentially doing? They're paying for this ballooning debt by debasing their own currency. It's happening at a truly destructive rate of around 8% annually. This means that a significant reason that asset prices appear to be going up is simply the rate of currency debasement driven by relentless government debt. It's not true growth, it's just an optical illusion. Even something as tangible as real estate, when adjusted for this debasement rate, is essentially a flat line, which ultimately comes back to the fact that there are only 2 assets that are outperforming: tech stocks and Bitcoin. But what happens when you divide tech stocks performance by Bitcoin? The Nasdaq 100, the best performing tech stocks, is down 99% against Bitcoin in the past 10 years, which leaves us with one asset that is actually growing your money. The traditional view is that you need diversified portfolios to spread your risk, and while generally that still holds up, any diversification that leads to performance under 8% is losing money and increasing risk. In real terms, Bitcoin is annualizing around 150% returns in the past 15 years. Bitcoin has become a black hole, fueled by the mathematically certain and very predictable rise of liquidity driven by global debt. So what happens from here? Let's throw AI into the mix. It's becoming more and more clear that AI and robots are going to replace humans in most work. There's a near infinite amount of digital AI employees, and humanoid robotics is projected to be the single largest industry in the history of the world. This breaks the GDP formula of debt growth, population growth, and productivity growth, which makes any kind of economic forecasting or predictions essentially impossible. And this is expected to happen in the next 5 years, roughly by 2030. AI will be the single most deflationary force the world has ever seen. But it isn't to say that money will no longer have meaning in the next 5 years, but it could happen in the next 20. The destruction that will happen in the stock market will be extreme, and that's an understatement. Jordi Visser is saying that the Fortune 500 will be a graveyard in the 2030s, and he's right. No technology company can compete on a long enough time frame. Software will be the first to go, but the hardware companies will not be long after. So how do you position yourself for a future of near infinite digital abundance? Easy. You buy digital scarcity. You buy Bitcoin. Companies are already waking up to this. There's 250 plus Bitcoin treasury companies worldwide, collectively stacking around 900,000 Bitcoin, and the rate that they're buying is accelerating. Jesse Myers, the Bitcoin strategy consultant to the Smarter Web company, estimates that Bitcoin treasury companies will own 50% of all the Bitcoin in the world. If we account for lost coins at approximately 3.6 million, then with some quick math you're looking at around 8.2 million remaining coins to be divided equally by around 8 billion people, which gives us a number of 0.001025 Bitcoin per person. But of course, even this won't be an equal distribution. Some will have more than this, and many will have much less. Which will you be? I hope you enjoyed this video. If you have any questions, please pop them in the comments, and don't forget to like and subscribe. Thanks for watching. See you in the next one.